Okay, guys, so this whole chapter is going to be on supply and demand trading. This is my strategy. This is how I trade, and this is how I take probably 85% of my trades is based on what I'm going to teach you here with supply and demand. The reason why I trade with these supply and demand zones is because they provide low risk, high reward trading setups. And ever since I've traded with this strategy, my win rate has been through the roof. But like I've said, win rates really do not mean anything. All that matters is your risk to reward ratio. And these zones, these supply and demand zones, provide low risk, high reward setups, which I really prefer. And supply and demand is what moves the market. And you guys will find out why and how in the next couple slides. So, it's supply and demand is economics 101. You guys go to school, you take an economics class, you flip over an economics book. The first thing you're going to learn about is supply and demand, right? And why do we learn about supply and demand? Because supply and demand is the heart of any and all market economies. For any market you guys look at, whether it be the real estate market, whether it be the car market, the force that drives price is just imbalances of supply and imbalances of demand. The only true reason why the price of something either goes up or down is because there's an imbalance of the supply or the demand. And the greater imbalance that you have, the greater the move in price. Now, this is how it relates to stocks. The greater supply and demand imbalance you guys have, the greater move in price that you guys are going to see. And in this section of the course, you guys are going to learn how to find these imbalanced areas in a chart and use this information to make high probability, low risk, high reward trades, right? And the reason why I love trading with supply and demand, like I've said, is that we're trading with the institutions that move the market. So by trading supply and demand zones, we are essentially, quote unquote, trading with the institutions that move the market. So by plotting these supply and demand zones, we're essentially trading and making the same decisions and moves that the big institutions are making and taking themselves. So once we understand the basic laws of supply and demand, right? Economics 101, what we learned in school, what you learn anywhere that you take economics, you're going to learn about the basic laws of supply and demand. And once we get these laws, we're going to be able to identify where supply and demand is the most out of balance, and this is where the price of a stock is going to turn. So, trading with these zones, we're going to be able to time the market turning points in advance with a high degree of accuracy. That's why I love trading with supply and demand. We can find these turning points in the market with high degree of accuracy because we are trading with the institutions. So, let's understand the basic laws of supply and demand, and I'm sure some of you guys know these. But the four basic laws of supply and demand are: if demand increases and supply remains unchanged, a shortage is going to occur. And if a shortage occurs, it's going to cause price to move higher, right? The law number two: if demand decreases and supply remains unchanged, a surplus will occur, causing price to move lower. So, really fast. If we have a shortage of something, that means there is a large demand and not a large supply. So that's going to cause price to move higher because there are people that do own whatever there's a shortage of is going to try to sell at the best and highest price because they know a lot of people want whatever there's a shortage of, right? Same thing with a surplus. If there's a lot of something and the demand decreases, but the supply remains unchanged, we're going to have a surplus and it's going to cause price to move lower. Do you want something that everybody has? No. You want something that there's a shortage of. And if you get something that there's a shortage of, you're going to pay a good premium for that, right? So now let's look about supply. Rule number 3. If demand remains unchanged and supply increases, a surplus will occur, causing prices to move lower. Does that make sense to you guys? If demand remains unchanged and supply increases, we have a surplus of whatever we have, right? And that's going to cause prices to move lower because we have so much of it. We can buy them at, let's say, maybe a wholesale price, right? We have a lot of it, we're buying at a wholesale price. And that means we're getting price We're getting the item or whatever we're looking at a lower cost. And step number 4 is if demand remains unchanged and supply decreases, a shortage occurs, causing prices to move higher. Like I said, if we have a shortage, prices are going to move higher because we have a demand and we have a less supply than we have demand. And this all follows along with this chart. This is just economics 101. So how this relates to trading is that when we're talking about supply and we're talking about the sellers who are willing to sell in the market, right? So when we talk about supply, we're talking about sellers. And when we're talking about demand, we are talking about the buyers who are willing to buy at the given price. So supply sellers, demand is buyers. Every time the direction of price changes in a stock, the relation between supply and demand will also change and it will become imbalanced. And that's our goal. Our goal is to trade during these imbalanced time periods, right? So what causes the market to become imbalanced is when supply exceeds demand or demand exceeds supply. Price will reverse at areas of an imbalance, and that's when we will start to see trend reversals, right? And changes in price direction because either the sellers are taking over the buyers or the buyers are taking over the sellers. So when we refer in this course to an imbalanced market, we are talking about a market where supply is either greater than demand or demand is greater than supply. And during these imbalanced areas, price will reverse because supply is greater or demand is greater, right? When we're talking about the market being balanced, we're talking about equal forces of supply and demand, and there's an equilibrium between buyers and sellers. Personally, I don't really care when the market is balanced because that's when price is going to start to consolidate and it's going to move sideways. So I don't really trade during these balanced markets. I don't trade the white space. I trade just areas where price is imbalanced. You guys will understand that as we continue to move forward. So I only trade when the market comes into an imbalance because that's when price will have the most violent moves. That's when price will start to reverse. And these are the areas where we can enter low risk, high reward trades, right? Looking for a possible reversal. So it's important to only trade during these imbalanced periods. We don't like trading balanced markets because that's when the forces of supply and demand are equal and we'll most likely see consolidation. Now, it's always good to have consolidation. It's just that I do not trade in these consolidation areas. I wait for price to come back, retest these consolidation areas, and move up or down depending on what type of trade I'm looking to put on. So here is a picture of Amazon and a demand zone. As you guys can see with this green box down here, this is a demand zone on Amazon. So we can gain a competitive edge as traders if we identify these supply and demand zones. Now notice I don't have any supply zones on my chart. And really fast, when I have post a chart and you guys see a green box, green means demand and obviously red or pinkish means supply. So on this chart, I only have a demand zone. There's no supply on this chart. Now, you guys are probably asking yourselves, how do we see this demand zone on a chart? How can we plot these zones? I want to learn how to plot these zones. And how do we take trades based off these zones? Before we get into that, I just want to explain and show you what the zone looks like on the chart and how a stock responds to these zones. And I have to also explain to you guys something about institutional trading and basically how we're following the footsteps of these institutions by trading with supply and demand zones, right? So I'm just going to scribble a little bit here on the chart. Let's say we don't know this day, right? We only see a demand zone that formed right here. Now the next day happens, right? I'm going to remove this. The next day happens. We wait for price to come into a zone, right? Because like I said, zones are imbalanced periods. This is a zone where demand exceeded supply. And as you guys can see, price moved up following, right? Now the next step is we wait for price to re-enter this demand zone. And we could take a low risk, high reward setup. As you guys can see by this lower wick, price briefly entered this demand zone. We briefly entered it, and look what the reaction was to it. We moved straight up, right? So where this circle is right here, we could enter this low risk, high reward setup. We get in here and we put our stop loss right below the box, right? It's a very simple trading strategy, but we have to understand what causes these zones to form, right? So what causes these zones to form is institutions. You can see on a stock chart where big institutions are buying, and you can see where they're selling. So institutions are the largest forces behind supply and demand in the stock market. Before I show you how to find these levels on a stock chart, I want to explain to you what an institution is, right? So an institution, or we could even say an institutional trader, is someone who works for some kind of financial institution. And this could be anything like a hedge fund, investment bank, a mutual fund, right? Prop house, just any type of money management or investment firm. This differs from retail traders, which we all are. We all are retail traders because institutions, one, are managing large sums of money. And when I say large sums, I'm talking a lot of money. And it's money that may not belong to them, right? It can belong to them, but they're just trading in large quantities that it could be just a pooled investment from other people, right? So they're just institutions trading. And we are all retailers trading in this big market. We're using our own money. We're making trades based off our own knowledge, right? And our money, our trades are not influencing the market, and they really do not move a stock completely like institutions do, right? So it's important to understand that institutions control large sums of money because that's the reasoning and the basis behind this trading strategy. The whole point behind this strategy is finding where these institutions are entering and exiting the market, right? As you guys see in this green box here, we can find out where institutions are buying or selling. I'm going to explain that to you guys. I don't want you guys to be lost, but you can find this from a chart. And once price moves into these zones, we get a reaction based off of it. So we just want to find out where these zones form. So institutions have the most money, and in return, they make the most out of that money. If you could trade with $100,000, I'm sure you can make 10% of that easily, right? And 10% is $10,000. That's way more than trading and starting out, let's say, with $1,000, right? So the more money you have, the more in return that you're going to make. It's obvious. That's where institutions come in because they're using such large sums of money. They're responsible for a good portion of price movements in the market because they have control over the most money going in and out of a stock. As a retail trader, we can take advantage and trade alongside these institutions if we understand this concept where they leverage, buy, or sell orders to make price move in their direction. So the problem with these institutions and trading with large sums of money is they have to create the orders that move the market. And if they wanted to create these orders that move the market, and if they tried buying or selling all the shares they wanted at the same time, they would cause supply or demand to become imbalanced, and price would move way far away from the origin, and it would happen very fast. Does that make sense to you guys? So I'm going to give you guys an example. Let's say these institutions wanted to buy 100 million shares of a stock at a certain price or a specific price. And we're talking about specific price, guys. Remember, we're talking about limit orders. You're setting an order to buy a stock at a certain price or better. So they're using limit orders because they're leveraging in such large quantities. So they wanted to purchase 100 million shares of a stock at a certain price. That's going to cause the supply to demand equation to become way out of balance. And they're never going to be able to purchase those 100 million shares at the price they want to because no one's going to be willing to sell to them those 100 million shares because number one, it's such a large quantity, and you have that specific price aspect, right? They want a specific price or better. So for every buyer, there's a seller, right? So for them to buy those 100 million shares, someone's going to have to be willing to sell them those 100 million shares. So The way around this is something that I call leveraging their position. So what these institutions do to enter or exit their positions properly is leveraging their position, or you could call it leveraging their order. And what this means, what leveraging their position means, is that these institutions place small and multiple orders that over time will get filled, and eventually all those small orders will add up to that large position they were looking to enter in the beginning, right? So I'm just going to go back really quick here. So they wanted to get those 100 million shares at that price. What's going to happen is the supply to demand equation is going to become imbalanced very fast, and price is going to move too far away from that specific price they were looking to enter. And some of their limit orders that are at that price will become unfilled, right? Because price isn't there anymore. And those limit orders are going to stay stagnant there. They're just going to be there because they're all unfilled orders. And these are orders at a specific price. And this is how we're going to get into these supply and demand zones. So it's important for you guys to know that once price moves, rallies, or drops, orders are going to be left at that specific zone, unfilled, waiting to be filled once price re-enters that level, right? So going back to leveraging their position, we get multiple small orders that over time get filled, and eventually over time all those small orders will add up to that large position that they were looking to enter from in the beginning. Let's say that 100 million share order, right? They could do multiple small orders that eventually equals that one large 100 million order. So here's another good example is Amazon has an average volume of 4 million shares traded per day, right? So this equates to 600,000 shares per hour, since there's 6.5 hours in every trading day. So 600,000 shares per hour every day. So if an institution wanted to open a position and buy, let's say 200 or 2 million shares at once, instead of leveraging their position, everyone else would see someone's eager to buy those 2 million shares, and price is going to jump quickly because we have such a big imbalance. Does that make sense? If you see on the level 2 that someone's eager to buy 2 million shares, price is going to move up quickly, and we're going to have a big imbalance right away, and we're going to have unfilled orders. So even for them to buy 2 million shares, that's half the average volume traded. So that just even proves itself that there's going to be such a big imbalance, because for them to put an order out for half the volume traded within a second is just going to cause a big imbalance right away, and it's going to cause price to jump quickly, fast. So if they pull their full order in at once, price is going to move far away from the desired entry or exit point. So what these institutions do is that they buy as many shares as possible and leverage their position without moving the market too far away from their desired entry. So they get as many shares as they can, these multiple small orders, they leverage in their position multiple times to equal that one big order, and they do this without moving the market too far away, causing a big imbalance right away, right? But at some point though, they still will be leveraging their position, and the number of sellers who are looking to sell will diminish if we're talking about a bullish move, right? Because they're buying, the number of sellers are going to diminish. And what they do is they push the stock higher to attract more sellers after the originating sellers diminish. And that is what we look for. And that's how we trade off supply and demand. So it's extremely important for you guys to understand, for every buyer in the market, there's going to be a seller. And for every seller in the market, there's going to be a buyer. One cannot coexist without another. If I'm looking to sell my shares, someone has to be there to buy them, right? Or if I'm looking to buy shares and go long on a position, someone has to be there to be selling them to me. So going back to the buyers pushing the stock higher to attract more sellers. Are you guys following that? These institutions, the buyers, push the stock higher to attract more sellers. That provides liquidity for them, right? They're buying, they have to get sellers looking to sell to their orders. So what happens is price is going to rise after these institutions bid the stock higher to an area where the institutions do not leverage into their position anymore, because it's at a price that they're not comfortable entering at, right? And this is where it gets really important. Whatever orders they were not able to complete are going to be saved until prices return to the area they were leveraging their position at. And this is the area that we as retail traders can buy or sell with them. Once we have identified the demand or supply zone, we can place a buy order in that zone for a high probability, low risk, high reward trading setup, right? When price returns to this level or zone, you call it, those unfilled orders of the institutions are going to fuel the remaining orders, and it's going to bring price higher as it did before. So that's how we profit, by following and riding with institutions. Now, this is going to be very confusing to all you guys, so I'm going to sum this all up, right? So step number one, institutions control the market because they're trading with large position sizes, right? These institutions are controlling it because they're trading with millions and millions of dollars. They're buying millions and millions of shares, right? They can cause the supply and demand equation to become very imbalanced because they put orders, they put large orders, right? And large position sizes. So step two, if they were looking to enter a position all at once, they would cause the price to move down rapidly if they were looking to sell, and the price would move rapidly to the upside if they were looking to buy. You have a 2 million buy order on an average of 4 million shares traded per day. You bet the supply demand equation is going to become imbalanced very fast, and price is going to move too far away from where they're looking to enter right away, right? So they don't want to do this because they're not going to be able to find enough buyers or sellers at the given price they're looking to enter, the specific price, to fill all their shares. So what they do is that they leverage their position or leverage their order, and they enter the trade in smaller, more frequent position sizes. That's important. We look for these areas where they leverage their position. That's the main goal. So after they do leverage their position, price moves in their favor, and now they're going to be in a green trade. They're going to be profitable on it. And they're going to be looking to exit the same way they did when they entered. This is how institutions trade, and this is how the stock market works, right? So step 6 is once price re-enters that level where they did leverage their position, all remaining unfilled orders, this is what's important, is the unfilled order aspect. So all the remaining unfilled orders that these institutions did not get filled originally will still be sitting there, right? They use limit orders. Limit orders do not get filled until someone market orders in and someone is willing to pay that price or better. So their limit orders will still be sitting there, and what they do is they attract sellers there for another imbalance, and an imbalance will occur if there's not enough sellers to breach this level. And in result, it's going to bring price higher as it did before, right? So this is the area where we trade. Step number 7. We wait for price to retest this level where all unfilled orders are at. And that's the area where they leverage their position, but it's also hard to identify while it's happening. While they are in the process of leveraging their position, it's hard to identify. But after price moves and returns to that level, that's when we look to enter because we have all those leftover unfilled orders.